Hi, good morning. You're watching the market right here on ET now, and so much optimism this Monday morning actually. You know, what happened last week was a different story. The fact that we managed to outperform most of our peers. We closed in at a year-to-date high. The Nifty, by the way, has managed to scale up all the way almost to that 18,500 print this morning, and last week we were at that 18,400 plus level. But of course, the fact that Biden and McCarthy have managed to reach an in-principle debt deal, that really puts last week's price action, Nikunj, into a completely different orbit. And of course, last week we did see high beta spaces like metals, etc., snap their losing streak, and IT, that's been on the gain.
Ayesha, you want to start? I think the debt ceiling news is something which is not going to have an impact on the market per se, because markets knew that, look, this would sail through. So from really in market standpoint, I don't think this is going to be a trigger, because markets were, in my book, markets for the week gone by, they were in a range. Yes, we may talk about that, okay, we snapped a two-week losing streak, but in terms of the collateral damage, there was no nervousness both in Indian markets and global markets because of the impending debt ceiling. Now, what we saw on Friday was, again, the leadership sector, which is the bank Nifty, that seems to be powering strongly. And in all probability today, the bank Nifty will make a new high. So Nifty is not, frankly, a lot away from that breakout mark, and bank Nifty at an all-time high. So this week, you actually would work with the following assumption, that the leadership sector is back, which is the banking sector, and Nifty has a strong possibility of breaking out of that resistance mark. If that breakout happens on the Nifty in the near term, then everybody will soon start talking about a new all-time high, a possibility which we have been flagging off. Markets last week did look slightly lazy and slightly tardy, but given the global setup, the news flow over the weekend, the fact that the bank Nifty is all set to make a new all-time high, I guess the lost momentum could be rediscovered.
Yeah, but as you highlighted, Ayesha, the clear big headline as well that the street is watching out for is what took place overseas, where you have, with the potential first ever government default, you had the US President Joe Biden and Kevin McCarthy reaching that final agreement, and this took place Sunday on a deal to raise the nation's debt ceiling and working in order to ensure that the Republican and Democratic votes actually do pass through in terms of to pass that measure in the coming week. And you also had the US President Joe Biden saying that it has been good news. That's what he said on Sunday evening. So that perhaps may not be fairly market moving, as Nikunj said, but definitely is going to be very closely tracked. Just a quick check-in as to how the global markets performed. You did have the US markets that did manage to notch up the fifth straight week of gains. You had a rally playing out on the Dow Jones, S&P 500, as well as the NASDAQ, and looks like, barring Hong Kong, the rest of the Asian markets seem to be following suit. So we will be just getting on board our experts as well to discuss that. But the debt deal optimism is certainly a talking point, as the Congress is going to be voting on that deal on Wednesday. But other than that, then, Nikunj, let's focus in as well on that interesting conversation you had, because it was a busy weekend for you with Chris Wood.
Oh yeah, I mean, Chris Wood is like this old India bull. For the years I've interacted with him, he's always been a big fan of what the India appeal has been and what the India story has been. Guess what? He is in Mumbai, and he was at our studio yesterday. I mean, very nice of him to come to our studio even on a Sunday. And he clearly is not only confident, but he feels that now that the rate cycle globally and locally has peaked out, I guess it's time to really bet on India. Guess what? He's added Zomato in his portfolio. Guess what? He feels that there is a probability and a possibility that the Sensex actually could touch 1 lakh. When I said 1 lakh, he said, look, you got to tell me in a different nomenclature. I said 100,000. He said, yeah. 5 years, strong possibility the Sensex could touch 100,000.
Okay, let's connect then with Taimur Beg, who's joining in, as well as Mithul Kutecha, to talk about the debt deal. Thank you so much for taking time out, Taimur. Just going to begin with you. The fact that an in-principle deal has been reached with Biden and McCarthy, just wanted to understand your outlook on what the implications could be for the global markets.
Good morning. So normally, of course, if a debt deal like this were to happen, you would say we should be long fixed income, we should expect rates to come down because all the worries are gone. But unfortunately, in the very near term, global dollar liquidity actually might tighten because the Fed, the US Treasury in particular, has ran down its cash balances so much that there'll be a major issuance of Treasury bills in the coming weeks and months, which is unfortunately going to suck out a lot of dollar liquidity. So yield curves might actually shift up as opposed to down, particularly in the short end. We are already seeing no respite whatsoever just because that debt deal, at least tentatively, has been worked out.
Mithil, just wanted to get your sense in as well, because I think, much of the markets already did know that the US is not going to hit a debt ceiling, right? Having said that, there is some amount of relief coming in the markets. Do you think this relief rally could have more legs?
Well, yes, I think it can. But I think, look, we've got the holidays today in the US and in the UK. Its activity has been fairly thin as it is. We haven't seen the sort of bounce in markets as one would have expected. There could be some caution because we still have a vote on Wednesday in Congress. And we know that there is a strong element on the right of the conservatives in the Republican Party, particularly the Freedom Caucus, that will be against some of these measures that have been agreed upon. Similarly, on the left of the Democratic Party, there is also a significant amount of opposition to some of this. So it is not a clear-cut done deal by any means, but there is an expectation that much of the center of both the Republicans and the Democratic Party will push this through. But as I said, look, it's not been a major rally in markets. I think there's a lot of other things to contend with. Taimur mentioned the issue about supply of T-bills, and I think that's absolutely right. And plus, there is still a lot of inflation to contend with, weakness in growth. All of this is not particularly bullish for markets at this point in time. So I think we will see a relief rally. Certainly will help risk assets generally. But again, it's not clear the magnitude of this rally going forward.
Taimur, okay, the debt ceiling fear is over. What's next? Because it's not that the debt ceiling fear is over. The world's going to become a bright spot.
Last week's data out of the US, but you see echoes of that elsewhere as well, which is that income growth worldwide is still pretty decent. And the US income data in particular show that consumers are still purchasing, maybe not goods as much as they used to, but services definitely. And that is true in the US, that is true in large parts of Asia, which means services inflation remains sticky. And that's what we saw in the core personal expenditure data for the month of April that came out of the US late last week. So we have a situation where tight monetary policy has done a lot of work. Growth has slowed somewhat. Inflation has come down somewhat, but none of them have happened sufficiently to give the Fed some degree of comfort, to give the markets a big room to run. Because as far as inflation is concerned, as far as growth slowdown is concerned, we haven't seen the concluding chapter of this saga play out. There's a lot of ifs and buts out there. Goods price inflation, I think we can safely say, is not going to be bothering us a lot unless something were to really terribly happen in Ukraine and energy prices shoot up. But short of that, goods price is not an issue, but services prices worldwide is an issue. And to me, that's the issue to sort of hone in the coming months as we try to figure out where is the top of the market in terms of rates and how much can they come down the road.
A view from you, Mithil, as to what you believe the trajectory could be from the US Fed. Do you think that we could anticipate bigger rate cuts then come next year?
I think we can. Look, our view is, in fact, that the Fed still hikes in June, which is not yet fully priced in. I think there's about a 1 in 2 chance of a hike for June. But markets have shifted more hawkishly of late. We've seen a backup in US Treasury yields moving higher. We've seen rate expectations tighten. I think some of this issue, of course, is the fact that inflation still remains sticky, especially on the services side. But look, if the Fed hike in June or maybe skip that and go in July, there could be one more hike in the pipeline. But what we do expect as we go through this year is the recession risks will intensify. We do see a recession taking place towards the end of this year and into next year. And we expect the Fed to cut rates more aggressively than the market is pricing in. So while we're a bit later in our view that we think the Fed will start cutting rates by around December, we could see over 200 basis points of cuts going into the next 12 months after that. So I think as growth weakens, we expect the Fed to be reactive to that by cutting rates. But look, inflation is still a problem. We know that services inflation is proving very sticky. In fact, even core goods inflation has started to turn up again. And this is a problem that the Fed still needs to contend with, despite the fact that we've got tighter credit conditions and also the fact that growth is starting to slow. So, this week's payrolls report will be particularly important to get a gauge as well to see how much the labor market and wages are softening, if anything.
Temur as well as Mithul for taking time out and joining in and giving us a view on all that's taking place overseas with the debt ceiling negotiations. But right back to Chris Wood, who was in Mumbai in our studios as well, and he remained very bullish on the India story, saying it is very possible that the Sensex could surpass the 1 lakh mark in the next 5 years. In an exclusive chat with ET Now, he spoke about why he's so bullish on India. Listen in.
You track Sensex more than Nifty, and we've discussed this over several engagements and separate interviews. What to your mind is not the probability but the possibility of the Sensex touching 1 lakh in the next 5 years?
1 lakh is
100,000.
Well, I think there's a huge likelihood that yeah.
I want to hear that loudly.
It's very
You
likely.
say that there's a
no. That to me is very reasonable. Yeah, very very easy to see.
So Chris Wood is of the view that in the next 5 years, the Sensex...
Let's put it like this. I would be disappointed if the Sensex had not touched 100,000 5 years from now.
Okay, so I'm going to capture and recapture this headline again. You will be disappointed if the Sensex in the next 5 years does not hit 100,000.
Yeah, absolutely.
It can go above 100,000 also.
Well, clearly, yeah.
All right, now let's talk technicals. C.A. Rudramurthy and Naresh, they both join us. Naresh, good morning. Thank you for joining us. Naresh, looks like the Bank Nifty will make a all-time high right at the word go.
Clearly, Bank Nifty has been the leader in this move and should be the first one to make a new all-time high. And say we should be getting closer to a new all-time high even for the Nifty going forward. And if you look at it, a lot of other indices have also made new 52-week highs and all-time highs. So if you look at Nifty Mid-Cap 100, it hit an all-time high. The small-cap indices are a little away, but majority of the indices are not far away. So we are getting into an all-time high across the board. Momentum continues to remain strong. And the best way to ride this move has been to continue to be bullish and expect pauses on every step. So right from 16,800, we saw a pause at 17,400. 17,800, then 18,200, and now after this move from beyond 18,400, the next pause should be closer to 18,800 odd levels, which is the previous high. But till the time this trend does not show any indication of bending, the best way to ride it is to continue to be bullish till the time this higher top, higher bottom formation continues. Keep looking out for new sectoral moves as well. So for now, we are seeing a lot of other sectors also picking up. Banks have done well. We are seeing a bounce back in IT. We are seeing a multi-year high even on the auto names. So overall, new sectors, new stocks are also coming up. Mid caps, small caps have seen good enough momentum. So it's not a case wherein only few stocks have gone and we are going towards an all-time high. We are seeing it across the board. So the breadth is also good. So overall, the same view. Next, expect a pause at around 18,800 odd.
We are about 400 points away from an all-time high. Looks like a new high this week or next week is coming then on the Nifty. Varesh?
So looks like say Nifty making a new high would not be far away from say over the next week itself. And more importantly, what we do about that pause at 18,800 odd levels. Because what we've seen is every time in this move, whenever we've reached closer to resistance levels, we've paused for at least a week or two. So at 18,800, 18,900 odd levels, we should see a pause. But in that period of time, we've seen the mid caps and small caps do well. And say by the end of this week, all the result season would be over for majority of the stocks. And then we can see a follow-up momentum across the board in the mid-cap and small caps. So for the next few days, it would still be large caps, but post that pause, I would start focusing a lot more on mid caps. For now, it's across the board focus, but post the pause, it would be mid caps and small caps.
Morning. Let's get in a take as to what exactly you're working with on the frontline indices. 2 weeks of consolidation. What are we in for this week? And share with us your top trades. Rudra, is my voice reaching you? Your take on the Nifty? Yeah.
Yeah, Nifty futures, if I say definitely yes, as told last week also, like it is headed towards all-time high. Question of only when, and for sure it is headed, but then I feel it has to happen this week itself. I'm looking at targets of 18,850 to 18,900 to come this week, and one can still go long because last Friday we saw that move decisively above those levels of 18,500, and even for the year 2023, Nifty is now at the highest point of time. Bank Nifty will break its all-time high today, and for me this market still has some more leg to go, and normally this last phase of parabolic kind of a move will happen much quickly, plus we see a steep bounce on the upside even from current level. So I won't be surprised if this week we see that parabolic kind of a move, and IT also will start performing from now on because we see more valuation comfort fundamentally on IT stock, and IT sector as such, even if you see that has also given breakout on chart. IT index itself is making that move towards the higher side, so I expect markets definitely to go to all-time highs. And on Bank Nifty, I see targets of 45,000 to come. Now I see even participation coming from Kotak Bank, SBI. These are specific moves which can now take market towards that levels of 45,000. And as usual, ICICI Axis Bank can continue its move on the upside. So I'm very bullish on market, expecting a big parabolic move this week. Stock specific for me, Bharti Airtel looks very strong. This will be the stock for the month of June series. For me, Bharti Airtel is ready for a target of 840, and eventually stock can go towards 4-digit number over a period of time. Keep a tight stop loss of 810 for this long call. I have a second buy call on SBI. SBI again, after results having made that consolidation, now it is headed towards levels of 600. So initially look at 600 as a target, and even 650 is possible. For a medium to longer time frame, have a stop loss of 585 for this long call.
Rudra, thanks for highlighting all your stock-specific ideas as well. Naresh, what's on your list?
So first is a buy on HCL Tech. The stock is making a cup and handle formation. The stock, say, it is what happened with the rest of the large cap IT names is they went back and retested the September lows or came very close to it. HCL Tech was one of the few large caps which actually did not go back to the lows, and is now clearly showing a resilience in the momentum also over the last few weeks. So for now, a cup and handle formation breakout is above that 1140, 1150 mark, very close to it on Friday's close. Once this breaks out, we could be looking at a move all the way to previous all-time highs also, very similar to what happened with a lot of mid-cap IT names. So a buy at current levels, the stop loss at 1100, a quick short-term target price of 1250. Second is a buy on Larsen & Toubro. L&T, after making that breakout move about 2050 levels, the stock had gone to 2400. And the base has been shifting higher. Earlier 2050 was the base, and now 2150 is the new base for the stock. The bottoms are getting higher, and now this correction has given an opportunity with a risk reward, wherein the trends continue to be strong for the whole capital goods segment. L&T has a relative catch up to do with the rest of the stocks in the capital goods space. So out here, looking at it to make a fresh 52-week high and all-time high from here. A good risk reward, stop loss at 2150 and a target price of 2400, 2500 in the short term.
Thank you so much for running us through your top recommendations, Rudra and Naresh.
Back with the market right here on ET now. Got a solid handover from the global cues, and this morning you are seeing Asia pick up quite a bit of momentum, considering that the US deal overhang has been lifted, or rather the debt ceiling deal overhang has been lifted. But a lot of stocks as well in focus, while the SGX Nifty, of course, is indicating a positive start for us. Sun Pharma, that's offered to acquire the shares it doesn't already own in Taro Pharma for $38 per share. Now, what does this mean for Sun Pharma, which currently owns 78% stake in Taro? Let me take it across to Sharad and get in more details.
Well, yes, an important development coming in for Sun Pharma, and they have actually given a non-binding interest as per the SEC filings to acquire 100% stake in Taro, and this will be an all-cash deal. Now, it's expected that Sun Pharma will be likely to fork out almost $300 million, but there is a history to it. And this proposal was also there earlier, 10 years ago, where they had actually planned to buy out Taro for almost $454 million, but there was some resistance coming in from the minority shareholders. Apart from this time the offer is coming in at almost $38 per share. Now that is coming at a premium of almost more than 31%, and that is why in the post-market trading hours, the stock of Taro went up by more than 20%, and the company expect to delist Taro from NYSE and make it a wholly owned subsidiary for the company. Now already in current levels, Sun Pharma is holding roughly 78.5% stake in the company, and the impact is expected to be positive for the shareholders, as the analyst community is expecting that Sun Pharma will have a higher access to cash reserves and also an improved outlook going ahead in the USA for the long term. But in the short term basis, there is certain problems, and of course there's a steep increase in the competition coming in the dermat segment for Taro, as well as they're expecting some price erosion in the medium term.
Sharad, for giving us all of those details. Moving right on then, let's focus in on Piramal Enterprises. Jefferies is bullish on the stock. They maintain a buy rating with a target price at $985, saying they believe that the retail loans will drive AUM growth down the line. Let's in fact take it across to my colleague Lisa, who joins in with all those updates. Morning, Lisa.
Good morning. Piramal Enterprise, they participated at the Jefferies India conference, and here are the key takeaways which were captured by the MD. Well, the important takeaways are that the asset monetization transaction that is expected to continue over the next few quarters. However, the run rate for that is expected to be lower than the monetization of 40 billion rupees seen in Q4. Now, moving on to the retail loan book that is growing, and that is expected to see AUM CAGR growth of around 15% over the next 3 years. And also on their wholesale book index, the stress recognition in the wholesale book index that has been largely done, and the management is focusing on building a granular loan portfolio in their wholesale book. They will also be continuing to focus on scouting for inorganic growth opportunities. Well, according to Jefferies, the growth in retail loan books that is expected to drive the operating expenses going forward, and that is also expected to see the expenses, and that will weigh on the return ratios also. But the loan mix shift and the operating leverage that is expected to lift the returns going forward. So on that note, Jefferies has released a note on Piramal Enterprise, and they say that at 0.6 times of FY24 book value, the risk reward that seems favorable, and also they have maintained a buy on the stock at a target price of 985, which entails an upside of around 28% from the previous close.
Piramal, which is going to be in focus, and Prashant Jain, director at 3P Investment Managers, believes that re-rating in defense stocks is now behind us. He also expects defense companies to grow at the rate of 10 to 15% a year.
I think again, in terms of the multiples moving up, they have played out. See, 2 years back, these stocks were between 5 to 7 multiples. And today, they are anywhere between 20 to 25 multiples. So I think the multiples re-rating has happened, but these are highly sustainable businesses. They have many growth tailwinds, both support of government, focus on indigenization. And I think the Ukraine war has also highlighted that you need to maintain large inventories of ammunition, because what you produce in a year can get consumed in a matter of days. And I think India also offers you competitive pricing for the technology what we deliver globally. I think the exports opportunity is also there, though it is smaller compared to the domestic opportunity. So I think again, coming back, it's in a similar position as the banks. The re-rating has happened, multiples are fair, but you can make some money as the earnings or the business continues to grow. I don't think these are rapid growth businesses. The order backlogs are very large, could be 5-7 years of turnover also. But the way this business works, I mean, you are absolutely right, to build an aircraft, or you have a number of aircrafts on order and you will deliver a certain number per year. So these order book will get exhausted over the next 5 to 10 years. So that's why I said, I mean, these are businesses that can, but they should still grow. I think between 10 to 15% a year they can grow. And if you add back the dividend yields, that will become a reasonable return.
All right, let's move on, and here are some top fundamental stock ideas. Sanjeev Bhasin of IIFL Securities shares some of his top trades.
First is Chemplast Sanmar, belonging to the Sanmar group in South. They've seen a huge accretion in European orders, and I think the underperformance of many years is coming to an end. Chemplast Sanmar, given the pedigree of the management, can be a huge outperformer. I think this is a very sweet spot in specialty chemicals, and this company is taking it from the front. The other is Jubilant Ingrevia, the parent company of Bhartiya's, or erstwhile known as VAM Organics when I started 30 years back or 40 years back. And I think VAM Organics spin-off Jubilant Ingrevia, even though there was weakness in agrochemicals, their other verticals are doing extremely well. So if you are looking for the next 1 year and a 40-50% upside, then these two specialty chemical names are very, very keen, where we think that there is a lot of opportunity on the upside.
Earnings still, and N. Kamakodi, the MD and CEO at City Union Bank, joins in to highlight their numbers. Mr. Kamakodi, great to have you on the show. Tell us a little bit about your growth in advances. Your growth is slower than that of the market, and during the year you had guided for a 15% plus growth. What is causing you to grow slower?
See, basically, if you had a chance to look into at the year beginning last year, we were not very robust about the growth. But in between, we felt we can increase our growth rate, and we were expecting things to improve. But we had some issues in between. Particularly, we had to strengthen our internal processes and systems. And in fact, we were balancing our growth between the both gold loan and also from the MSME loans. So all the issues are on the, they were there on the public domain. So we had to take some extra care before we actually press the growth button. In fact, we, took our legs off the growth pedal even before the COVID, somewhere in the, last quarter of the calendar year, 2019, just even before the arrival of the COVID. So the, in fact, we used to have an approval rating of about, our approval to new customers almost came down by 50% because of that decision, which we decided to, increase once again last year, which we couldn't do. But we hope this year we should be able to compensate for all such things. Nevertheless, we were able to protect our profitability. In fact, we could see the, our unwinding of NPAs and recoveries and all had, substantially improved. The NPA addition minus collection almost increased by about 250 crore in the financial year 23 compared to financial year 22. Despite having all other, issues, we were able to have a 23% growth in our overall profitability, and also having a return on assets at close to, 1.5% as we had, which had been our long-term average. We hope to continue with the same ROA and the profitability growth for the current year is what we see at this point of time.
All right, Mr. Kamakodi, so would you say then that the problems with regard to provisioning are now behind, and when can we expect you to accelerate your growth? What's the target for FY24?
Exactly, you are bang on. There were, we need to make some improvement in the overall what you call our risk measurement and all, which we had learned in the from our experience in the past. So for which we have already started. Particularly, we had to make some changes in the upgradation in the digital lending processes, whatever we had done. In fact, for that process, we are in the process of finalizing what you call deal with Boston Consulting Group as our consultant to improve our digital lending processes, for which the activities are on. Those, like say, the fine tunings and all will help us as we expect. For the current year, we should be like say we are aiming for about 12 to 15% growth, but bulk of the like say it will be skewed towards the second half. So we will be starting the process of fine tuning, and we should be able to see these numbers coming as we move forward, and the incremental growth should get smoother by the second half.
Well, one more trend we are seeing is that the yields have not gone up meaningfully in Q4 FY22. Walk us through why that is happening.
No, you might have observed about 25% of our portfolio is with the gold loan, which has got a lower yield compared to our MSME proposition. And but sequentially, if you have got a chance to see, there is some passing of the like say when the rate hikes happened in the system, some passing and all has happened. We have not gone into any portfolio purchase or co-lending or anything like that. Our entire growth rate is through the regular advances, whatever we had been doing so far, and no change in the no major significant change in the composition of advances.
Right. So where should one see the NIMs in FY24, and what would be the target on the steady state?
They should be staying at the current level, maybe plus or minus 10 basis points. The point is that, like say, the indications are that further rate hikes, like say, the probability is coming, it is, like say, decreasing. So some rate hikes which we had already done towards the end of the last year or beginning of the current year should be having some amount of impact on the yield. At the same time, if in the overall margins, like say some amount of like say repricing of funds also, like say is something is remaining over a period of time which has happened. And also you could see some amount of reduction in the credit deposit ratio, which is also contributing for that. So considering all those factors, our NIMs should be staying at the current level, plus or minus 10 basis point is what we envisage at this point of time.
So where can we see your credit costs for FY24, and how should we expect your ROAs to pan out?
Basically, the credit cost number is something like we had about 90 basis point for the current year. Our like say once the net NPA numbers come back to the pre-COVID level, these numbers may come down by another 25 to like say 30 basis point from the current level is what we envisage, which should be helping our improvement in the ROAs. But now, as we have clearly seen, we are able to see we are already at our pre-COVID level average ROA of 1.5%. We said that we will be getting back to that level by the second half, but on overall year basis, we are almost there at 1.46%. So our long-term average had been 1.5%, and we will be even our current numbers suggest that we have enough confidence to see that this number increasing as we get into the financial year 23-24.
Right. Congratulations on your reappointment also for 3 years, which the market has clearly cheered. Tell us about where should investors see the bank in the next 3 to 5 years, especially now with regard to its size.
We are currently at almost, like say, nearing the 1 lakh crore of total business. So I would like to see the bank at least 150,000 crore total business by 2026 when I complete my tenure.
Mr. Kamakodi, we'll leave it at that. lots of other stocks as well, which are going to be in focus this morning. And let's just bring up some of them. Of course, we've been talking about Sun Pharma, the fact that they're looking at further acquisition of Taro shares. That's going to be one stock which is going to be in focus. We were looking at M&M's earnings as well. Shortly on the show, we're going to be speaking with Dr. Ayesha as well and getting a perspective on not just where the auto and the farm division is headed, but where the group as well is headed in the next foreseeable future. But Sandeep Sabharwal as well joins in on the show to talk about which way he thinks the markets are headed. Sandeep, hi, good morning. Great to have you on the show. Even though we were sideways for the better part of last week, we managed to scale to that 18,400 print, and it seems like it's going to be 18,500 this morning already, and maybe new highs soon, Sandeep.
Yeah, hi, morning, Ayesha. So that was always the premise that we'll move to new highs as the interest rate cycle peaked out and the performance of the Indian economy actually held up versus what's happening all around the world. So I believe that we are still well positioned. However, the only thing is that for people who are waiting for the markets to fall further in March, the markets are up more than 10% already. So once such a move happens, then short term, for a very short term view, they should be a bit cautious because markets can give jerky corrections anytime. But directionally, I'm still positive and bullish. I believe that over the next few months, by next year, we'll see markets much higher than current levels.
All right, we'll get right back to you, Sandeep. But in the meantime, let's focus in on the stocks on the editor's radar. And today we're talking about the IT cluster as well as tire stocks like Balkrishna Industries. Let's begin then by talking about Balkrishna Industries. What a steady move. It touched its 52-week high on Friday's trading session. But Nikunj, in comparison to some of the other players, what do the valuations look like?
Look, Balkrishna Industries is one of those haloed stocks. They've delivered, they've got fantastic return ratios, differentiated company. But profits are not there. I mean, Page is a great company, but you saw what happened to the Page stock, largely because of the growth and largely because of this halo effect which the stock had created. When earnings are not there, these stocks just reverse very, very sharply. I will not be surprised that if we see a very sharpish kind of cut even for Balkrishna Industries. The geography where they are large, I think, is Europe, and that geography is not growing. So margins have not been great, numbers have not been great, and valuations are high. Now in the short term, when valuations are high and when growth is not there, and when the margin pressures are there, the stock tends to underperform. So I will not be surprised that if Balkrishna Industries in the near term could actually do what actually Page did, let's say on Friday.
Yep, and the valuation is well pretty expensive compared to its peers. Moving on, let's discuss IT because that has clearly been in the spotlight of late. We have seen though that the FI weightage is at about 9.8%, most underweight versus the MSCI. And if we were to look at the entire IT space and how it's performed, Nikunj, what's the outlook?
See, Avanne, everybody right now is universally bullish on banks and universally bearish on IT. So I will not say anything new. But my limited point is that you cannot have such a sharp variation when markets are about to make a new all-time high. Look, the gap between banks and IT has increased. But markets have also increased, and IT has a weightage. I mean, these are companies which are important, these are companies which are growing. So when the India narrative is changing, you cannot have such a large differentiation that everybody will only buy banks and everybody will only sell IT. My limited point is that you may actually see a comeback in some of these stocks. That could be a deep swell, more like a trading bounce, more like a tactical, technical trade, at least in some of the large cap IT stocks. I think the bearishness when markets are about to make an all-time high in the IT sector, which is a growing sector, which is a sector where FIIs, they love to own this sector, I think is just too high. So I will not be surprised that even though everybody has got this very favorite, theme that you buy banks and you sell IT, I think you buy banks but don't sell IT. That should be the way forward according to me. Because if you look at the 5-year averages for some of the stocks, even on a trailing basis and even on a forward basis, they are way below the 5-year averages now.
Yep. Okay, that's the outlook coming in on the IT space and really the approach that one should be taking, Ayesha.
Okay, and here's Chris Wood, and the stars are all aligned, he says, in India's favor, and he continues to remain extremely bullish on the India story. He says FII flows are here to stay.
Yeah, I would have to admit that tactically I'm more bullish now than a year ago, because a year ago we had just commenced the RBI monetary tightening cycle, And actually, at that time, the RBI had started off being a bit behind the curve. But we've now had, I believe, nearly 300 basis points of monetary tightening, which is probably more than people thought this time last year, probably more than I thought. So what's been amazing is, frankly, how resilient the stock market has been during this monetary tightening cycle. More resilient than I or actually my colleagues would have expected. And now, my base case, as is the base case for most people now, is that the monetary tightening cycle in India, if not America, is over. So that, I think, makes the stock market look more interesting tactically. Structurally, I remain as positive on India as ever. But basically, the last year has allowed earnings growth to catch up with valuations.
So would you say Indian markets, for a long-term investor, if you have to look at Indian markets probably from the prims of valuations, are they reasonable or are they attractive?
No, the valuations are okay. They're not super cheap. They're not cheap at all, but they're certainly not crazily expensive. So I would advise your viewers to remain structurally invested in India. And clearly many Indian investors are doing that, because probably the key reason for the stock market's resilience in the last 12 months has been the ongoing flows into the Indian domestic mutual funds, most particularly via these installment payment schemes.
So do you think the flows which have come back into India from foreign investors, they're real and they're here to stay?
I think they're real. There were a lot of foreign investors at this Jefferies conference I was at last week. There were a lot of domestic foreign fund managers. And I believe foreigners historically are only moderately overweight India. Normally they'd be more overweight than what they are right now.
Sandeep, let's discuss IT. I mean, markets are at an all-time high or nearing an all-time high. And the gap between where IT was versus where IT now is, when markets are at an all-time high, flows are coming, do you think one should not continue to ignore it?
So it depends on how many stocks you want to buy, what's your perspective, and what kind of holdings you have. So for someone who's a pure large cap investor and they hold IT and then they think that we should be exiting now, maybe it won't be a time to exit now because of the fact that it's underperformed so much. For someone who's looking to buy afresh, I would still think that allocations to IT should be moderate only and less than the index weightages, because the stories across other domestic sectors are much stronger. Now, one can argue that a part of that is built into the stock prices, but I think this entire theory of worst is over, best is over, and trying to juggle portfolios based on that is not a strategy which works very well. So we have to ride the winners till a point of time valuations become very high and the gap becomes excessive, which I don't think has happened still.
Okay, a lot of other stocks as well which are going to be in focus this morning. We've been talking about as to how pharma is clearly back. Today, of course, Sun Pharma is going to be in focus. They're looking at upping their stake further in their subsidiary Taro. There's also Lupin which is in focus. The Health Canada nod has come in now to market generic version of Spiriva in Canada. There's also Aurobindo Pharma, wherein the margins have come in at a 3-quarter high. They came out with their numbers, and the Q4 numbers are largely in line with estimates. Sandeep, where in this market would you go contra, if at all?
So I think contrarian approach does not mean that you go and perform stock buy companies which you know are fundamentally not going to do well. Contrarian approach is more about buying into companies where the market and the investors hold much lesser than what they should be holding relative to what the growth of the company could be. So I think that's how I would like to approach it. We've been hearing of buy IT pharma for the last so many years, because there's a set of people who just think that because they have not performed, they are contrarian. So it's very true that when the market moves up, it moves to a new high, etc. All the stocks will perform, but then we have to buy stocks which think can have durable growth with earnings growth over the next 2-3 years. So in a nutshell, I can't say that we see that across the board in the pharma sector. Sun Pharma is the only pharma stock we own because they've been doing well over the years and much better than rest of the pharma sector, and we continue to hold. Lupin saw first signs of turnaround this time, so that can be a contrarian bet. X of that, I don't see much of a story in pharma.
Numbers which came out of the weekend, and we've got decent numbers which have come from some of the contractor companies or construction companies. I mean, NCC could be a special situation, but I was looking at numbers from Ahluwalia, a company which you track, Sandeep. Do you think there is still some more juice left in some of these pure vanilla construction companies?
Which are focused on their balance sheet, which are focused only on the EP side, not gone and taken up bought and ham projects, which we have seen in the past, have hurt companies. Results of both NCC and Ahluwalia were exceptional. NCC, in fact, the PBT grew from 100 crores to 300 crores. Last year, same quarter, there was exceptional profit. If you remove that, the PAT and PBT growth, in fact, is almost 200% for NCC. Order flow has been very strong, and they have been actually able to reduce debt while growing so much. So I think these are exceptional set of numbers. I believe the market still underappreciates what's happening internally in the company and the way they've been executing. I would think they'll do well. Ahluwalia again was exceptional set. The order book is now nearly 10,000 crores vis-a-vis around 4,000-5,000 crores, which was there last year. And the next couple of years, they'll not only grow rapidly but have higher margins and improve profitability. And relative to growth prospects, I think both these stocks are still cheap.
Okay, and a slew of stocks also which are going to be in focus today. There's Restaurant Brands Asia, there's HDFC, PB Fintech, a lot of deal buzz and behind the scenes action in these stocks. Sharad is here with all the updates. Sharad?
Well, yes, in focus we are having Restaurants Brands Asia and PE firms Advent International and General Atlantic are closing in on Burger King's stake sale. Now, overall, Everstone is having almost 41% stake in Restaurants Brands Asia, which actually operates the Burger King brand, and they also operates brands such as Subway and Lavazza coffee brand in India. Apart from this, overall the industry, we have seen that there has been a degrowth when it comes to the Western life foods segment. Apart from this, the second deal which would be in focus would be HDFC, and over here Baring EQT is expected to buy Credila Financial Services with a valuation between 10,000 to 12,000 odd crore rupees. Now do remember, this is an educational loan arm of HDFC, and the deal is expected to go through in the month of June, just before the HDFC's merger. Now the buyout fund is expected to buy in almost 90% stake in the company, while HDFC is expected to retain the remaining 10%, and they are allowed to actually sell that stake over the next 2 years. The third stock would be in focus in terms of deals would be Policy Bazaar, PB Fintech, which is the company where Tencent has actually offloaded 2.1% stake, which roughly translates into 94 lakh shares at a value of 962 odd crore rupees. Now, overall, Tencent's stake in the company has actually fallen from 8.4% to 6.3%. And amongst the buyers, it is Societe Generale, where they have acquired almost more than 20 lakh shares.
Thanks very much, Sharad, for giving us all of those details. Moving right on then, Sandeep, wanted to get in your take on new age tech companies. What's the outlook here? Do you believe that now with the Cleanup Act in place and financials really playing catch up, that it merits a relook?
So I've gone through the results of all these companies, the management commentaries, etc. So I think most of the managements are trying to play the market in terms of saying what the market wants to hear. But internally, I still believe that many of these companies are not ready for delivering profitable growth, especially when the growth overall slows down. So I would still wait it out. I would think that these sporadic up moves which happen post some news flow or management commentary might not be very durable. So I'm still on the wait and watch mode.
In fact, I would say the back of the stock has been broken. is Star Health. This is owned by late Rakesh Jhunjhunwala, big investment by Rare Enterprises. But from its IPO, it's nowhere close to its issue price. Nowhere close to its IPO price. I think IPO price was 800 plus. It's at 534. Even though they've turned the corner for the quarter gone by, the stock is under pressure. ICICI Lombard, well, some relief could kick in there because ICICI Bank technically can increase stake now in ICICI Lombard. And ICICI Bank does not need. There was a time when ICICI Bank had to sell their stake in ICICI Lombard because they needed capital. Now I think ICICI Bank could be looking at increasing their stake back in ICICI Lombard because they don't need capital and they've got a lot of buffer after the credit cycle has turned. So isn't this extraordinary, Sandeep? I mean, they've sold stake in ICICI Lombard a couple of years ago because they were desperate for tier 1 capital. And now they're going to be buying it back.
Yeah, and it's a very rare phenomena that you sell off something and then you get the opportunity to buy it back again. So I think that is reflective of the exceptional turnaround which has actually happened in ICICI Bank, where today it stands at top of the heap in terms of both performance, quality of the asset book, the kind of excess provisions they carry, etc. So, and ICICI Lombard obviously trading at lows of, I don't know what the exact price right now is, but I think last I saw it was at a 52-week low or near a multi-year low. So it makes sense for them to increase some stake at this price.
Okay. Rudramurthy, Reliance below the 200 DMA, and now that's ironical. Markets aiming to make a new high, and the company which has the highest weightage on the Nifty is below its 200 DMA. I think Rudramurthy cannot hear me. Okay, Nuresh, over to you for Reliance.
So that has been the case. Reliance Industries has been going through a consolidation or a sideways phase. And the stock has a tendency to do that after a big move. So that big move in 2020, wherein it was a leader, from being a leader, the stock has now become a stock which just goes nowhere. And this is what happened previously also, if we go back to 2010 to 2017 also. So out here, till the time we don't go about 27.50, that is the band. The only case which is interesting is that Friday's move, it was the leadership stock. It contributed 50 points out of the move, and it has given a small flag breakout. So that opens up a target price of 2700, 2750. And that could be the fillip which we need to take Nifty towards that 18,800 mark. So Reliance Industries is setting up for a short-term move to 2750, but a major trend for the stock starts once it goes about 2750. The stock was at 2350 back in 2020 September, and we are now in say May of 2023. The stock was available closer to that 2300 mark as well, and so it's been a long period of consolidation, hardly any returns. But shorter-term charts have developed well. I would be positive here. I would actually be looking at a buy at current levels with a stop loss below 2450. And if this trends up, it could go all the way to 2750.
Sandeep Sabharwal, would you buy Reliance now? It cannot happen, bhai. It cannot happen. That markets are nearing an all-time high and Reliance is below the 200 DMA. Are we missing on something? I mean, I think all their businesses are doing well. Windfall tax is out. Retail is doing okay. Jio is in a fantastic groove.
Yeah, so I would say that for people who are willing to take a contrarian bet and looking to buy into some pharma or some stocks, I think Reliance is a better opportunity because Reliance does have triggers going for it in several of its businesses, and it's also underperformed significantly. Its valuations have come off hugely over the last 2.5 years. After it went up excessively, then it's a 3-year almost consolidation. I would think that I would agree that Reliance is a better contrarian bet in the large cap side than some of the other sectors.
All right, Sandeep, good to have you on board. Thanks very much for joining in with an outlook on what you make of the market setup. Well, let's move right on then. Just about waiting for the pre-open rates to kick in this Monday morning, and given the kind of global cues, we are expecting it to be fairly healthy. But let's find out those mid-cap trading calls from our chartists. Nuresh, what's catching your eye today?
So that would be a buy on Gujarat Gas. The stock has given a short-term breakout finally on Friday. The stock started making a base around that 460 mark, and now we are seeing a possible breakout in the near term. So out here, the stock is setting up for a triangular breakout, which has a minimum target price of 550. So buy at current levels, the stop loss at 485.
All right, check in on Gujarat Gas. That's what Naresh is advising. And Rudra, your top mid-cap call for the day?
For me, Onward Technology looks very, very strong. Fundamentally a strong company. Also, I feel IT can now outperform for short term. So for me, Onward Technology stock having given breakout above levels of 415, 420, this stock is sustaining those levels above 420. And now again, after a big price breakout with volume, this stock is headed towards 500 for the short term. So I'm looking for a target of 500 initially with a stop loss of 440.
There you have it. There are your top mid-cap recommendations. But here are some of the other top headlines then to track. Russia has unleashed airstrikes on Kyiv overnight on what is now being termed as the largest drone attack on the city since the war. This comes amid the city's efforts to mark the annual celebration of its founding. Now, according to Ukrainian military officials, almost all the Iranian-made aircraft were shut down. The Air Force said that it shut down 52 out of 54 drones launched against the city in successive waves, killing 1 and injuring 2 people. Meantime, President Erdogan has extended 2 decades in power on the elections in Sunday. This is in Turkey, and this is the reaction that you saw played out on the Turkish lira that slipped to a record low to the US dollar. Remember, the lira, which is prone to very sharp swings, has now weakened more than 6% since the start of the year and has lost over 90% of its value in the last decade. Back home, India's top wrestlers Vinesh Phogat as well as Sakshi Malik and Bajrang Punia, who were protesting at Jantar Mantar in Delhi for as many as 35 days, have been detained by the Delhi police as they tried to march towards the new parliament building during the inauguration. Do remember the protests have started with been seeking arrest of the WFI chief, that is Brij Bhushan Sharan Singh, on account of sexual harassment. Meantime, the Prime Minister will be flagging off the first Vande Bharat Express train in the northeast, which is in Assam today. The northeast-bound Vande Bharat will be running from New Jalpaiguri in West Bengal to Guwahati in Assam. And you've got the Union Home Minister Amit Shah, who will be embarking on his 3-day visit to the violence-hit Manipur today to resolve the ongoing crisis. Shah will be working to end the ethnic crisis and deliver justice to people. And to sport, in the blockbuster IPL finale between CSK and Gujarat Titans, that was unfortunately postponed due to heavy rains in Ahmedabad. The match is now scheduled to be played out tonight. Do remember, if CSK managed to ink a victory today, it will be their 5th IPL title. And meantime, Indian shutter H.S. Pranoy has defeated China's Weng Hongyang to hit Malaysia in the Masters men's singles title. And with this victory, he has won the maiden BWF World Tour title. Meanwhile, he also becomes the first ever Indian to lift the men's singles title in the Malaysians Masters Super 500 tournament. All right, let's check in on the pre-open rates this morning. And in tandem with what the rest of the globe was throwing up, it's a tick of green, 0.6% higher on the Nifty, around the 18,600 mark, by the way. And the Sensex is up by about 70 points in trade. Keep monitoring the currency as well, about 82.5 versus the greenback. But yes, it was that very special and exclusive conversation which we had with none other than Chris Wood over the weekend. And he believes that banks will continue to be a consensus call, but he sees massive opportunity in the real estate sector right now, saying that the upcycle will sustain. Listen in.
There is a consensus view on owning banks, but I'm going to still own the banks. I've been running my Asia ex Japan long only greed and fear portfolio since 2002. So I would say in the more than 20 years that portfolio has existed, if there's one sector where there's always been an allocation in an Asian context, let alone an Indian context, is Indian private sector banks. So to me, that story remains intact. That's the most straightforward story in India. So if there's a global investor who wants to invest in India and hasn't got the bandwidth to invest in lots of stocks, that's probably where they're going to invest. But right now, with the monetary tightening cycle over, the obvious place to add to, at least I think it's over, the obvious place to add to exposure is property stocks. So the property stocks went vertical in 2022.
22, yes.
When we got second half of 22, they went vertical because suddenly the market realized the property upturn was finally happening after a 7-year downturn. Last year they corrected because we're in a monetary tightening cycle, but actually the property market kept the actual physical property market kept recovering. So the moment we get hint of easing, the property market stocks will do very well.
So can I say
the property stocks will do well?
Yeah. So can I say that Chris Wood is in fact urging our viewers that don't buy real estate, but buy real estate stocks in India?
Well, right now that's the safer trade, but I think they'll both be going up. The other point about real estate is because you had this dramatic, when I say dramatic in its impact, Real Estate Regulation Act, which has caused this dramatic consolidation amongst developers, which means there's a fundamental lack of supply because it's much harder to develop property now from a developer standpoint because you've got to have the balance sheet to keep 70% of the pre-sale cash flow in escrow, which means that the supply is going to be lagging the demand. So I think it's a very straightforward story.
So Chris, your portfolio is in public domain. So I'm going to just read off the names what Chris Wood's model portfolio currently has. It has Godrej Properties, real estate company, GLF, India's biggest real estate company, Macrotech developer, India's biggest residential real estate company, and I think there is Century Textiles there, which is also real estate play.
Real estate related play.
Yeah. So you pretty much like 4 real estate stocks, even though the weightage of real estate in the Nifty is very low. You are not overweight, but you are double overweight on real estate.
Yeah, but in my Asian portfolio, I added to the real estate stocks last week.
So when you tell your clients about buying into real estate stocks, do you get a pushback or are they open to the idea?
No, I think the domestic institutions here have always had a prejudice against property business, property stocks, because they don't think it's a long-term business. But actually that's a bit strange because people buy property stocks in the UK market, the US market, the Chinese market. So it's really a question of where you believe we are in the cycle. But it may have been, some of these prejudices against the property companies may have been valid in the past, but this time around, given the very dramatic intervention of RERA, you can only be developing in India as a listed company if you've got a strong balance sheet. So you have a dramatic consolidation which should be to the benefit of the survivors.
You track Sensex more than Nifty, and we've discussed this over several engagements and separate interviews. What to your mind is not the probability but the possibility of the Sensex touching 1 lakh in the next 5 years?
1 lakh is
100,000.
Well, I think there's a huge likelihood that yeah.
I want to hear that loudly.
It's very
You
likely.
say that there's a...
No, that to me is very reasonable. Yeah, very, very easy to see.
So Chris Wood is of the view that in the next 5 years, the Sensex...
Let's put it like this. I would be disappointed if the Sensex had not touched 100,000 5 years from now.
Okay, so I'm going to capture and recapture this headline again. You will be disappointed if the Sensex in the next 5 years does not hit 100,000.
Yeah, absolutely.
It can go above 100,000 also.
Well, clearly, yeah.
1 lakh plus on the Sensex next 5 years. Well, that means a compounding of 12 to 13%, which frankly is not very high considering the bent of the economy and considering where the starting valuations right now are. Okay, now the Bank Nifty is all set to make a new high today. If it makes a new all-time high, that means the leadership is with banks, and which it is. It's very pronounced now. But interestingly, if you look at indices which are off from their 52-week high, the closest one actually is the Bank Nifty. The small cap index and the mid cap indices, they've already made a 52-week high, and we're looking at an all-time high here. But the Bank Nifty had gone to these levels, minus that touch and go moment which happened 10-15 days ago. Actually, the last reference point should really be December 2022. From middle of December, when the Bank Nifty was at similar levels, there has been a change. And the change is SBI is underperforming and Kotak Mahindra Bank is outperforming. HDFC Bank has made a comeback, while Bank of Baroda and other PSU banks, and especially mid-tier PSU banks, are taking a backseat. IDFC Bank has hit a new high, and AU Financials, AU Small Finance Bank also has made a new high. So there are a lot of changes which have happened, even though the Bank Nifty levels have pretty much come back to the same, same points. I don't think AU Financial is down 39%. We need to check this graphic. That I'm very sure that it's not down 40%. This year it's up 19%. Nuresh, chart the whole journey of Bank Nifty from last December to this December. SBI has gone down and Kotak has come up.
So out here, say what has happened with State Bank of India as well as Kotak is interesting in terms of the outperformance State Bank of India has done, but Kotak is now setting up much more interestingly. If you look at Kotak, what has happened, the stock has just gone nowhere. So every time over the last 2 years, the stock comes as closer to 1950 to 2000, it takes a flip back towards 1650 levels. Now this has happened multiple times over the last 2 years. In between, even in 2021, it just saw one spike towards the 2200 mark. But if you were to go back to 2021 as well, the same thing, 1950, 2000 has been a problem zone. So the thing which I'm watching out for, that SBI has outperformed, it has played out. But can we get to a place where Kotak Mahindra Bank starts outperforming? And that could be once we confirm a move about 1980, 2000. So that's a stock which is looking very interesting. Same thing is there with HDFC Bank, 1700, 1750 has been a problem zone. So, and we've come to an all-time high on the Nifty, wherein two heavyweights in the banking space have not made a new all-time high. So HDFC Bank is to be 25-28% of the Bank Nifty, and it's still not at an all-time high. Kotak Mahindra Bank, another 10% of the Bank Nifty, not at an all-time high. So overall, we are seeing rotation in the banking space, but going forward, Kotak Mahindra Bank is one I'm watching out for. Today also it could come closer to that 1980, 2000 mark. If it can sustain, this could open a move towards 2250, and then it could actually be an outperformer to SBI after a long time.
So that's interesting that if you look at the three heavyweights on the Nifty, Reliance, HDFC Bank and Infosys, none of them are at an all-time high, and Nifty is nearing an all-time high.
Yeah, Nikunj, these three heavyweights have not performed. Whereas if you see the second tier or even the third tier kind of stocks, for example, if I see bank, other than HDFC Bank and Kotak Bank, look at Axis Bank or look at even ICICI Bank, they have done fabulously well. In fact, ICICI from levels of 800 is now over 950 plus and headed towards 1000 levels. Similarly with Axis Bank, if I see again, this stock has definitely outperformed. When you see similar to ICICI Bank, it has outperformed and again headed towards levels closer to 1000. So I feel now the last leg of move in index can definitely come from Reliance and even Kotak Bank. And if these two stocks start performing, Nifty will sooner go to those levels of 18,850 to 18,900. And I also see IT, which has not performed still now, will now start performing. In fact, for me, two stocks which can do very well from IT will be Wipro as well as Tech Mahindra. So if you look at charts of Wipro, it has given clear breakout above levels of around that 395 to 400 zone, and Friday it closed above those levels of 402. So I feel Wipro from current levels can head towards levels closer to 450, 460 zone. And even if you look at Tech Mahindra also, stock really looks very, very strong to me. F&O position has been on the positive side. So this stock can also head towards levels closer to 1,180 to 1,200 zone. So for me, yes, this last leg of move, especially in index, can be from these stocks which have not performed. So I'm bullish on IT, specifically on Wipro and Tech Mahindra, and surely Reliance and Kotak Bank can also outperform and take Nifty sooner to those levels of 18,850 to 18,900 zone.
Getting set then for a record high on the Nifty Bank. And here's some interesting data. We got just that close to actually hitting a fresh all-time high. And that was not all that long back. It was in the 15th of May. 44,151.7 is what we hit. Having said that, we were closer than that back in December 2022, on 14 December to be precise. We hit that mark of 44,151.8. So, I mean, academically, we are already in any case there. And right now, that of course is the pre-open rate for the Nifty, but the Nifty Bank as well at 44,276 is set to open at a fresh record in any case. Just looking at the year-to-date contributors, and it's quite surprising, Nikunj. While ICICI Bank, of course, is a no-brainer, and that's put on a 5.5% thereabout gain. IndusInd Bank has held out very smartly. Axis has underperformed. It's fallen 1.6%. SBI has been a rank underperformer, down 4%, and HDFC Bank as well, down 0.7.
Yeah, so it's, I wouldn't say ironical, but I would say it's good and bad both. That the three heavyweights on the Nifty, that includes the Reliance, below 200 DMA, Infosys, nowhere close to its 52-week high all-time high, and even HDFC Bank. So the three heavyweights in between the weighted should be 20%, broadly, plus minus 1 or 2%. Yeah. That's not an all-time high. Yeah, so they are nowhere close to its all-time high. So 20% of the Nifty, which is dominated by the sumo stocks, which normally are the ones which are led by institutional investors, are not at an all-time high. And Nifty is yet met an all-time high. You cannot have the market going up in isolation when these three pillars are not aligning together. Now, if I'm an optimist, which I am, I think it's a matter of time when HDFC Bank or Reliance has to kick in. Infosys could be work in progress after the quarterly numbers. So the upside for the Nifty when the breakout happens will not get limited and restricted. That means that Reliance will catch up, HDFC Bank has to catch up, and the Nifty is going to be marching forward rather than it's going to be an all-time high touch and go moment and comes down.